Okay, this one's a little bit more advanced. I have a lot of good followers, and I've been told that some people would like me to get into a little bit more depth in the nitty gritty of what we do here. And so, one of the things I want to talk about are the different types of fractional interest in real estate investment opportunities. So this is a little bit different, but I think real important. So the first thing we need to know about are partnerships, and partnerships are pretty simple and pretty basic. I mean, this is when you and a buddy or you and some kind of partner are going in and you're buying a piece of real estate just together, and you can have some kind of official legal partnership, or they're just deeded into your names or whatever. So sometimes these are to develop or rezone a piece of property. That's why we would have a partnership. Next one is very similar is tenancy in common. And this could be more multi-level. These are, everyone's on the deed. It's not just a business relationship, but it is a inheritable tenancy in common, where everyone has a interest in the deed of the property. So they're partners and partners on the deed. So a partnership may or may not be on the deed, but a tenancy in common is definitely everybody's on the deed. Then we have joint venture projects, and this is where we have a partnership, and perhaps we have a landowner that is investing their land equity into the project. And then the reason why it's a joint venture is because the secondary investor is going to be investing capital into the raw land, either to survey it, rezone it, entitle it somehow, but to increase the value. And that investment can be as much or even more than the raw land of the property itself. I mean, we just had one a couple of years ago. The amount that it cost to loop the water through the subdivision was the same amount as the raw land purchase price. So, roughly $1.5 million to $2 million for the property, and it was $1.5 million to $2 million for the water. And that was just the water. We're not talking roads, we're not talking soils, we're not talking surveys, we're not talking erosion control, we're not talking about legal planning. I mean, there's a lot going on. Just the water was the same as the raw land. So joint venture projects, we have an investor partnership with the landowner. The landowner's collateral is the raw land, and the partner's collateral is the knowledge, experience, hopefully, and capital to get the project approved. The other thing is we have an LLC. LLC can be different, fractional interest, because we may have more than one property. Sometimes it's just one property, but this is where we're actually distinguishing the percentages of the partnership. So you could have 5%, 10%, 90, whatever, 50, 50, 3, 3, 3, 30, 30, 30, a third, a third, a third. And so this is a creation of an entity that has percentage shares in one or more properties. It has some shields and protection for the investor that might be good for a particular investor that wants to have a level of a legal shield. But one of the things that people don't realize about this is that if we get into trading of the shares and selling of the shares, it can be a slippery slope. And a close friend of mine actually has an associate that is doing time for something like that right now. So LLCs are fine, but we have to worry about when we cross a line, and the next line that LLC can get into is there's two of them. One of them is what we call a REIT, and that's a real estate investment trust. And these are entities that are created to be publicly traded stocks. And so, a REIT is something where, let's just say we have 1,000 shares and each share is, 1,000th of the property. And they own like a shopping center or multiple shopping centers or a strip mall or something that, or could be multifamily apartments. And so, or it could be a combination of all of those. These are like real estate conglomerates, so that all the real estate's put together, and then you own shares of that. So those are publicly traded. In order for someone to do a REIT, they have to have a high-level securities license, so they can trade in those, and those are publicly traded. And there's a lot more rules and regulations that go into that. So one of the things that we really have to worry about as when we play the real estate game is when does that LLC become a REIT, and so that can get a little tricky. And my advice there would be err on the side of caution, because you have one investor and that's not going to go well.